Good afternoon, everybody. Welcome back to Markets for Millennials for the weekly analysis from October 3rd through October 7th. Don't forget to hit the like button if you're here and you enjoy the content, and subscribe if you have not yet, and share this video with anyone you think may find it helpful. And before I get into the charts, I want to just take a look at a couple of things. The big news today here on Friday was the unemployment numbers. The unemployment rate fell. Payrolls rose by 263,000 jobs, and that was higher than what was expected. And obviously, we also saw, when you look at the data, labor force participation edged lower. That was definitely something that I think was expected, because the JOLTS job data earlier this week was also showing that the labor force participation was going to be lower. Average hourly earnings rose, and the problem with the markets today, the markets really tanked on this news today, because it obviously is showing that the labor market is still strong, in spite of various companies talking about cutting jobs. It provides the Federal Reserve a considerable amount of runway to continue raising rates, or at least according to them. And so the markets are aggressively repricing based on that. And so a couple of things that just want to go back to just to get our bearings. I wanted to make a comment because the first couple of things that we'll look at in the charts are going to be the yields and the DXY. This is from something that I posted. This was back in September. And I feel like, if I can say so, I feel like I've been right on the pulse of the DXY, the dollar index, basically since, for the whole year. I became a dollar bull back in November of 2021. And obviously, if I go back and look at the chart, at that particular time, I was kind of back in and the end of 2020 and into the first part of 2021, expecting the dollar to, on this bounce, if you remember, going into March of 2021, and then late into April and May, I was expecting the dollar to make lower lows. That was when everyone was getting apocalyptic. The dollar was going to go to 80, and eventually to 0. And then it continued to come back up. And then as soon as we made the higher high in October and retested it, I was ready to become a dollar bull. So I obviously missed the exact turn. But I caught the trend at the right time, because obviously the dollar for all of 2022 has been on a tear. You can actually see right in January the trajectory of the dollar went from something that is semi-shallow to being very steep. And so I feel pretty good about that. But I had said in September that I had been talking about the DXY on this really abrupt move up, that there were various levels to watch, and one of those levels that I was preparing for was around the 111 range. And then if you remember back from my video from last week, the new lows in the markets, be careful chasing, I talked a lot about the DXY and some different levels, including looking at the I don't have the trend line up here anymore for some reason, but this was the trend line I was watching. And I had said last week in the video, and again, the video is on the channel. It's last week's video if you want to check that out. But I had said that I was watching what would happen when we reached this trend line, and I had said that I was going to expect a pop down below the trend line, and that would be a really interesting place to start to again be placing long orders again. And obviously that original analysis has proven so far to be correct. Now, what I am also watching here on the dollar, if we do a Fibonacci retracement, is we're hitting right up around the 618 level. And the reason I highlight that is if we go to an asset like Bitcoin, Bitcoin's really easy to use because it has a couple of blow-off tops. If we go to Bitcoin and we look at the blow-off top from the 2017 peak, then what you see is a lot of times on the dead cat bounce, on the bounce of hope, I guess if you want to call it that, before things really roll over, it gets right around the 618 level. And so that's definitely It's definitely a place to watch. It's definitely something to be aware of as we move forward on the dollar. But for now, this analysis on the DXY was a really important thing to pay attention to. And it's really interesting too, because if you go and you look at, let's just do let's just do the Great British Pound to the US dollar. If you look at this on the chart, what I was watching for was I had this trend line right here, and you never take the breakout. So a lot of people, I think, obviously some people missed this to the upside. And I think when these trend lines get broken, it's really easy for people to want to chase that momentum. But you have to wait for a retest. And so actually what I had done is when price popped up above, the next day as price was coming down, I actually took another short position, and put the stop loss right above that green wick, because again, for me, I feel like the macro situation in Europe and in the U.S. Doesn't bode well for the euro or the British pound, and you can actually see if you go to the euro US dollar as well, you kind of had a similar situation take place. So if you just do something like, actually, how did I have this trend line? Sorry, I'm trying to do this in real time. Something like that. And as we came up, as soon as we started to sell back down a few days ago, I took a short and placed the stop right there above that wick. And that's proven to be a good trade thus far. And on the move, you move the stop loss down once you get to a 1-to-1. And it was so tight that basically before the end of the trading session, I was able to move the stop loss to break even. But in short, my point is that I feel like I've been doing a pretty good job on the DXY, paying attention rather than looking at this chart and saying, oh, it's gone too far, the U.S. Can't keep tightening. Rather than going on what I want to happen or what I think should happen, I'm just letting the chart tell me what's going on. And the thing you have to remember is, as long as price is above the 50-day moving average, the momentum is definitely clearly in favor of the bullish price action. And this can go. I mean, if you want a good thing to look at, like history to look at, if you go on the monthly chart and you look at basically from late 1980 all the way up into the Plaza Accord in the mid 80s, that's almost 5 whole years that went by, and the dollar appreciated 87%. And by contrast, if you go to just our year to date, or actually if you go from the bottom of the current move, we're only up 25%. So on a percentage basis, we have a lot further that we could run, and on a time basis, we have a lot further that we can run. And so I think that that's really important to point out. This is also, sorry, I'm going to show you that in a second. This kind of downturn in the dollar did allow, at least for a few days, that relief bounce that I had talked about in my newsletter. My newsletter, where last week I talked about the S&P 500 being set up for a bounce. So I said I expected that there would be a significant squeeze as people pile into shorts. And there were some other people that I saw that were making similar calls. So I don't feel like I was unique in that, but I do want to just highlight that I was warning about chasing downside momentum, just as I did obviously in the video that I posted, be careful chasing. By the way, if you want to subscribe to my newsletter, it is listed in my Twitter profile called Financially Free. You can go and check that out. I think that that's something important to point out. Now, taking a look at Treasury yields, they've been following the same kind of pattern, although the yields, the 10-year yields have recovered. They've recovered slightly better than the U.S. dollar. And I again want to point out that I feel like I've been well on the pulse of yields for some time, calling back here in the beginning of August that we would get a higher high, and we did. And a lot of people are really trying to find the bottom, or the top in yields, the bottom in bonds. Everyone keeps, all throughout this move, people just continue to try to call tops in this move, just like they've been doing on the DXY. and you have to stop looking at the markets and analyzing according to what you desire or even what you think should happen. You can only let price and the macro dictate what you're actually positioning for. So in short, though, if we just think about the week, let me go to the S&P chart. We did get the bounce, a bounce like I had thought we might get, but we only got 2 days of buying, and prices quickly come off. It looked like we were going to get a reversal, not a reversal. It looked like we were going to get a sustained bounce to the upside because Wednesday's price action was pretty deeply red, but had recovered most of the way before the close. But then obviously price didn't cooperate yesterday. And then today on the jobs report, we basically just sold all throughout the day. If you pull it up on a 5-minute chart, except for till the very end when we got a little bit of a recovery, you can see we got the initial drop down and then just kind of sustained selling all throughout the trading session. And so just a lot of pressure on markets. And so you're seeing, basically you're going to continue to see that, I think. All eyes are on the CPI for next week, and that's going to have a huge bearing on what goes on with the dollar and with equities and all risk assets in general. But I do want to highlight the bounce. I was hesitant to say that it was over because until we make a lower low, there's still a total possibility that we might get some price action back to the upside and get up close to 3,900 on the S&P. And that would not be out of the question if you think about what happened over here as price came up, came down, came up, came down, came up, and then actually continued to move upwards. And then we ended up creating something like a wedge, right? And I was talking about that. I know that drawing's really bad, but we talked about that on this channel. So I think that's something to be aware of. And so I would argue, just like last week, you have to be really careful about chasing this downside momentum. And so I do have this. I was still looking at the old low from June. I was interested if we would close below it, but I think now that it's there, I'm actually going to get rid of this. It's no longer really relevant, at least for now. And I want to highlight that green support, that horizontal level, which actually goes back to 2020. So I'll be watching that next. That is where we got a bounce. That's where our bounce came from technically. And I will also be watching for a lower low on the S&P here into next week, because if we make a lower low, then per my own TA rules, I'm going to take a trend line and make it right there, because I basically like to track multiple different I like to track long-term, medium-term, and short-term trend line momentum. And so this is obviously going to be a really big deal if we make the lower low here, because it's going to mean that it's going to have me thinking that the potential downside in the near term is considerably high, and that we could go really far down really fast. So that is something that I wanted to highlight as well. The NASDAQ's getting pounded, had gotten pounded today as well. I'm going to move that line down because we broke back down again. Put it right there. I posted on Twitter, I was looking for these targets. I think these targets still stand. But one thing I did miss, just in hindsight, just so you guys can all see, is I had this resistance level. It's not the cleanest level. It was marking lows from May. And it was very light support on occasion. It looks like we did run into that as a resistance level, so that was definitely something I missed. But I was originally, and I still kind of am, for a bounce targeting an area just north of 1,200 or 12,000, and then another area, if the bounce gets some legs under it, then an area at about 12,900 or maybe just below 12,900. Right now it doesn't look like that's going to be the case, but it is something to watch. What was I going to go to? I'm going to go to crude oil, actually, because crude oil, in spite of all of these concerns, crude oil on news from OPEC this week is really taken off. OPEC going to reduce its output. I wanted to clarify on that, though. I can't remember off the top of my head, but essentially there's a lot of misunderstanding about what the reduction was. It wasn't in the literal output, it was in the quota. and they are actually already producing under quota, so that's something to note. However, energy is now, I think the move down on energy is done. I do think we are going to get a retest of this trend line, so I would be careful here chasing the momentum. I hadn't I didn't have any new positions down here. I didn't get that turn. I wasn't sure when it was going to bottom. So what I'm looking for is to get a retest down either on the descending trend line or on the high, on this little swing high from mid-September. Again, either it's going to come down and retest that trend line, or it's going to come down and retest that level and move off. So I will be looking for that before I try to establish any new positions on oil. The other thing I wanted to mention is gold. Did poke above my little channel that I had here, so it has me thinking I want to make some adjustments, but I'm not really certain here. But whatever the case may be, if it did, if this trend line was right or wrong or whatever, it was a failed breakout because we came back below. And so I think that that's something that is important to watch over time. Gold, again, has been a really good indicator of where everything else is going to be going. So I think that that's something I want to keep paying attention to. And then Bitcoin had a breakout, and it looks like actually on today's price action, it's really flirting with the retest of that breakout. And again, this breakout's a really big deal because this trend line goes back to the November high and then the April and March bounce of earlier this year. So that's something to watch as well. The risk to reward is pretty good here. It's entirely possible we get another flush down, so I would be careful, but it wouldn't be out of the question to play with entries because where your stop loss needs to be. You either got to put it below the September low, the wick there, or put it below the June low, which is not too much further down. But you have clear risk to reward there, so that's going to be something you'll want to watch too. Beyond that, most of the other equity indices are all the same there. Something I did want to mention because I haven't been looking at this in these videos, the yield curve still inverted. A lot of people look at the 10s 2s and the 30s 5s, but obviously a more important one as far as the recession goes, or predicting a recession, is the 10-year 3-month, and that has not inverted yet, and it's actually going the opposite. It's trending, I should say, the opposite direction of where you would want it to go as far as being able to say with certainty that a recession is coming, because this has a 100% is 100% accurate when it comes to predicting the recession, and we're just not there yet. So it's possible we could get there. But until we get there, there's no sense in thinking that we're going to see any sort of Fed pivot anytime soon, no matter what's happening in the Treasury market or elsewhere. So that's kind of what's going on this week. I hope that this video was helpful for you. Again, don't forget to smash the like button and subscribe if you haven't. Go visit my newsletter. Leave a comment if you felt that this was helpful. And yeah, thank you for watching. I'll see you guys next time. Have a good weekend.